These early firms also adopted a management fee structure inspired by Alfred Winslow Jones, the 2 and 20 model, a management fee on capital committed, not just invested, as well as a share of the profits. Early hedge fund managers had understood that if they were adding value rather than just picking stocks, they deserved better compensation. In the latter part of the 1970s, a new phenomenon arose, and that was something called a leveraged buyout, where a small amount of capital was put in as equity and a large amount was borrowed. As investors saw what these early buyout pioneers were doing, traditional investors, 99% of whom still put most of their money in public markets, began to take notice. But it was still considered not quite prudent under the prudent man rule to put your money into those kind of investments. But that changed in 1978. The U.S. Labor Department ruled that leveraged buyouts and venture capital should not be excluded from pension investments, allowing public pension funds to invest in alternative assets. Oregon and Washington were the first public pension funds to move in, followed by others. Until then, portfolios were rigidly 70-30 or 60-40, with almost no alternatives allowed. With this change, venture capital and buyout funds grew rapidly, while Silicon Valley flourished in the late 70s and early 80s as the personal computer industry took off. And as these firms grew, so did the pool of capital. By the late 80s and early 90s, nearly every major pension, endowment, and corporate fund was allocating to private equity, fueling a major boom. Firms like Gibbons, Green, and Clayton Dubilier were early buyout pioneers. In the late 1970s, a group of financiers left Bear Stearns to start their own firm after being told that using the bank's capital for buyouts wasn't the business. At Bear, they had already been experimenting with small, leveraged buyouts. Around a decade later, RJR Nabisco became one of the most high-profile leveraged buyouts in history, capturing public attention and later chronicled in Barbarians at the Gate. The transaction and the aggressive use of leverage, sometimes as little as 1% equity and 99% debt, helped transform the industry. I started Carlyle with a number of partners in 1987. Over lunch at the Carlyle Hotel in New York, Bill Conway, Dan Daniello, and I began discussing the idea that would become Carlyle. At the time, private equity was still taking shape and largely concentrated in the United States, but we believed there was an opportunity to take this emerging model and apply it on a global scale. So the industry had not yet even taken on the name private equity. We were still called leveraged buyout firms. And as Carlyle grew, so did other firms like ours, and we began to do several different things that hadn't been done before. In addition to doing leveraged buyouts, we began at Carlyle, as did other firms, to offer other